Have you ever seen a dividend ETF advertising a 15% annual yield and thought, wow, that's incredible, I need to buy this right now? I get it. That number is seductive. Monthly income. Passive cash flow. Financial freedom. But here's the thing nobody tells you at the beginning, in many cases, that income isn't coming from profits. It's coming from your own money being handed back to you, slowly, quietly, while the fund value sinks beneath your feet. Today, I'm going to show you exactly how that works. We're going to break down what separates a genuinely good dividend ETF from one that's designed to look good on paper while quietly destroying your wealth. And at the end, I'll give you a simple framework you can use to evaluate any dividend ETF in under 5 minutes. Let's get into it. Let's start with the most important concept in this entire video. When most people evaluate a dividend ETF, they look at one number, the yield. 10%. 12%. 15%. The higher, the better, right? Wrong. The only number that actually matters is total return, which is the combination of any change in the fund's net asset value, or NAV, plus all distributions received. Here's a simple example. Imagine 2 ETFs. ETF A pays you a 10% yield every year. But its NAV drops 10% per year. Your total return? 0. You haven't made anything. You've just received your own money back in smaller pieces. ETF B pays you a 4% yield. Its NAV grows 6% per year. Total return? 10%, and your capital is actually growing. ETF A looks better on the surface. ETF B actually is better. This sounds obvious when I say it out loud. But billions of dollars flow into high-yield products every year from investors who never run this calculation. Not all dividends are created equal. There are 4 different ways a fund can pay you, and they have very different implications for your wealth. Number 1, eligible dividends. This is the gold standard. The fund holds shares in profitable companies. Those companies earn real money and distribute a portion of it to shareholders. That cash flows through to you. This is genuine, sustainable income. It comes from economic activity. It's the kind of dividend that can grow over time as the underlying businesses grow. Number 2, capital gains. The fund sells some of its holdings at a profit and distributes that gain. Also legitimate. Also reflects real value creation. Number 3, return of capital. This is where things get tricky. Return of capital means the fund is literally sending your own money back to you. It might not sound alarming, after all, you got cash, but every dollar of return of capital reduces the fund's net asset value by exactly $1. You haven't earned anything. You've just moved money from your left pocket to your right pocket, with a small transaction fee taken out along the way. Number 4, option premiums. This applies specifically to covered call ETFs. The fund sells call options on its holdings to generate extra cash, which gets distributed to investors as yield. The problem is structural. Selling call options caps your upside. If the underlying assets rise significantly, you don't fully participate. And if they fall, you still fall, you just have a small premium to cushion the blow. The best dividend ETFs pay primarily from eligible dividends. The worst ones are constructed almost entirely from return of capital and option premiums, dressed up to look like the good stuff. Let me take a moment to specifically address covered call ETFs, because they've become enormously popular, and enormously misunderstood. The pitch goes like this: we take a portfolio of stocks or bonds. We sell covered call options against them. That generates premium income. We distribute that premium to you as a high monthly yield. 15%. Maybe more. Sounds great. What's the catch? The catch is asymmetry. When markets fall, you fall almost as much as everyone else. The option premium gives you a tiny cushion, maybe 1 or 2%, but you still absorb most of the downside. When markets rise, the option buyer profits. You don't. You've sold your upside to someone else in exchange for that premium. So over a full market cycle, down, then back up, you end up worse off than simply holding the underlying assets directly. Now here's the critical variable: what are the underlying assets? If the underlying assets are strong, long-term compounders, like a broad technology index, the covered call strategy costs you real money. You cap your gains during the inevitable bull market recoveries. You participate in the crashes. The math works against you over time. But if the underlying assets are in a sustained downtrend, like long-duration government bonds during an aggressive rate hiking cycle, you've got a double problem. The assets themselves lose value. And the covered call strategy caps any potential recovery. You are structurally trapped. This is exactly what happened with certain bond-based covered call ETFs in 2022 and 2023, when some saw their NAV fall by 30, 40, 50%, while continuing to advertise yields above 15%. That 15% yield. In many cases it was just return of capital. The fund was returning your own shrinking investment to you, dressed up as income. I want to give a name to what happens when a bad dividend ETF gets into trouble, the NAV Death Spiral. Here's how it works. The fund maintains a high fixed distribution to attract and retain investors. The underlying assets decline in value. The distribution now represents a larger and larger percentage of the shrinking NAV. To maintain the distribution, the fund must sell assets or return capital. This accelerates the NAV decline. Which means the distribution ratio gets even worse. Which requires even more asset liquidation. And so it continues, until the fund either drastically cuts the distribution, or the NAV erodes so severely that the fund becomes unviable. At the extreme end of this spiral, a fund can face forced liquidation. When that happens, investors receive back whatever the NAV is at that point, which may be a fraction of what they originally invested. The fund didn't fail because of fraud. It failed because the math was always unsustainable. Alright, let's make this actionable. Here are 5 questions you should ask before buying any dividend ETF. Question 1. What is the source of the distributions? Look up the fund's annual report or T3 slip history. What percentage is eligible dividends? What percentage is return of capital? If more than 20 or 30% is return of capital regularly, be cautious. Question 2. Is the NAV stable or growing over a multi-year period? Not just the yield, the actual unit price. Pull up a 5-year chart. If the NAV has been declining steadily, the yield is partially or fully an illusion. Question 3. What is the total return, not just the yield? Calculate NAV change plus distributions received. That's your real return. Many financial platforms now show total return directly. Use that number. Question 4. Has the distribution been cut before? Counterintuitively, a fund that has cut its distribution during a downturn is often healthier than one that maintained it. A cut means management prioritized NAV preservation. Maintaining an unsustainable payout means management prioritized marketing over your wealth. Question 5. What is the management expense ratio? Every basis point of fees compounds over time. A fund charging 0.6% annually versus 0.1% will cost you tens of thousands of dollars over a 20-year investment horizon on a substantial portfolio. Let me leave you with the core principle from today. NAV is the root. Distribution is the fruit. If the root is dying, the fruit means nothing. A high-yield number is a marketing tool. Total return is the truth. The best dividend ETFs don't necessarily have the highest yields, they have yields that are honest, sustainable, and supported by real income from real businesses. In the next video, we're going to look at specific Canadian dividend ETFs that actually meet these standards, comparing their fees, their historical returns, their drawdowns, and their underlying quality filters. And in the third video, we'll cover how to hold these ETFs in the right account types to minimize your tax burden, because even the best investment can be undermined by poor tax placement. If you found this useful, please like and subscribe. Drop your questions in the comments, I read everything. See you in the next one. This video is for educational purposes only and does not constitute investment advice. Please consult a licensed financial advisor before making any investment decisions.